Hi, I'm George Pino, the CEO of Commercial Brokers International. Thanks for joining in again today. Today, I have a great guest, Dan Lewkowicz, who we're going to talk about single tenant net lease investments. For those of you who have tuned in before, we've kind of delved into that a little bit, but I wanted to kind of get a more up-to-date picture of what's happening now, but also delving a little bit further and going into retail centers perhaps as well. So stay tuned and listen in here. So, Dan, you are a single tenant net lease or retail investment specialist.
Yeah, my primary focus is definitely centered around retail. I do sell a lot of single tenant retail deals, also a lot of shopping centers. Sometimes I venture outside the box. Recently sold a few large resorts, but that was for a client who I had a long-standing relationship with. But yeah, that is in essence what I focus on.
Okay. And do you focus in a specific geographic area, or are you kind of just all over with, because I know with single tenant net lease, it can be a little different in that, a lot of times commercial real estate agents try and focus in one specific geographic neighborhood, but with single tenant net lease or retail investment sales, kind of all over, go where the properties are.
Yeah, I mean, all over the country, we transact in every state. I
Okay.
right now have listings in, I don't know, 8 or 9 different states.
Okay. Well, why don't we talk a little bit about kind of what's happening within the market? I know that last year, it really slowed down on the single tenant net lease investment and retail investments in general. Part of that had to do with the debt issues, but also a lot of it had to do with tenancies starting to pull back. A couple of them have recently declared bankruptcy. I mean, we just had Red Lobster just the other day, just declared bankruptcy and is already shuttering store locations down. So when it comes to that, one thing I have noticed though, and a little bit of a bright light, is that sales are starting to pick up right now, and cap rates are actually kind of adjusting to where they were prior to the increase in uh, rents, but kind of to a little bit more stabilized. What are you seeing in the market?
Yeah, so I mean, listen, unfortunately, it's for whatever reason a lot more newsworthy to discuss the bankruptcies. And I could sit here and count off hundreds, maybe thousands of units that went through bankruptcy. I mean, last year alone, we had 3 major Burger King franchises go through bankruptcy. We had Tom's Kings that had 91 locations. We had Meridian restaurant group that had 121 locations, and then we had Premier Kings with 172 locations. That's close to 400 Burger Kings that went through bankruptcy last year. Red Lobster, Rite Aid, Bed Bath and Beyond, the list goes on and on. But here's what people don't talk about is that for 3 years in a row, we have a net positive number of store openings. What that means is that there's more stores opening than there are closing, which is a very good sign. And that's going to happen again this year. So I'm
Mhm.
not phased. I mean, listen, it's like anything. Retail is an evolving organism, and
Mhm.
that which isn't doing well dies off, and that which is doing well takes its place. So all in all, I think that it's a relatively healthy retail environment. As you discussed with kind of what we would call maybe deal volume, yes, definitely 2023 was significantly down from the prior 3 years. What we have noticed, myself, us as a brokerage who sees on a more macro level, as well as speaking with my clients, just had a conversation today. The last 8 to 10 weeks, we've definitely seen an uptick in listings, in
Mhm.
offers, and in closings.
Yeah.
I wish I could put my finger on it and point to 1 or 2 different variables that are causing that. I don't see any causal factors other than perhaps there's capital on the sidelines that's looking for a place, a safe haven to go, and maybe that there is some concern
Mhm.
about the equities market, the stock market, and that a correction is imminent. So,
Yeah.
I think that all things being said, the fact that we have such a massive and rapid increase in rates and that things are still moving along, it says a lot about the economy, and it says a lot about the state of commercial real
Mhm.
estate.
Yeah, no, absolutely. And I think you made two key points there. One number being the net openings. The fact that the net openings are actually higher, that's good. And to me, and pro tip for all you viewers out there that may be looking into getting into single tenant net lease investments, just understand then what this is essentially what Dan is telling me and what I'm interpreting it as is that they're closing locations that are underperforming. So it's just as important, even more so important now, to really delve into the demographics of the location. As we all know, location, location, location when it comes to real estate, it's true even with single tenant net lease. Even if you have a 20-year lease term, you never know what may happen. So you want to know how you can exit and how they're performing. The bottom line is if you have a tenant and they have a very low performing store, they may be there for 15 years, but they're going to leave at one point or another. So delve into, before you acquire the properties, really delve into your due diligence and make sure that location is performing. Mitigate your risk. Maybe it's the number one performing location based upon visits in the state or country, or top 90 percentile. That's pretty good mitigation of risk, I think, for a tenant going out of business at that location. The other thing you brought up is that I think one thing I've noticed within the marketplace is that 1031 money is coming back. And how
Yeah.
are you
Yep.
seeing that as well? Where, I'm seeing clients that are repositioning assets that they're holding on to now that they're comfortable with the market and the interest rates where they're at. They're now selling those assets and then still repositioning them and perhaps getting a little bit higher return going through a single tenant net lease or a retail investment model. Are you seeing
Yeah.
that?
Absolutely. I mean, right around 37% of our transactions involve a 1031 exchange. That could be on the front end, right? I'm representing somebody who's selling a property and now needs to do a 1031 exchange, or on the back end, they've done the 1031 exchange and now they need to buy something. What I have noticed, it's interesting, is that, it used to be that when someone was in a 1031, they just, whatever was available, they grabbed, because there wasn't a lot available and things weren't on the market long and there were a ton of offers coming in. So it was almost like I'm in a 1031, I got to grab something. And what I've noticed today, I just dealt with this over the weekend, a client that's looking to buy a building. We had a great building. There were a few nuances that made it a little bit uncomfortable for them, that made them think that they might not be able to complete the 1031 or have to pay taxes. And they decided to completely pull out of the deal and look for something else. So I have noticed in general, more of a sense of anxiety amongst, sellers or people who have already completed the sale of their down leg, the property that they are relinquishing, right? And are now in the process of finding another property, or even sellers who are considering selling, but then know they have to do a 1031. There's a certain level of anxiety that wasn't there before, that they're not going to be able to find the deal that works for them. So, how do we overcome that? We have to get creative. We have to be aggressive and find them as many deals as possible. We have to be quick, because if it's a good deal, it's going to go.
Yep, I agree with that. I mean, it's regardless of the market, if it's a good deal, it'll sell and goes quick.
Yes.
So, where are you seeing right now when it comes to the debt? Are you seeing your clients put debt on properties with, we're still dealing with cap rates on a single tenant net lease, typically between 5 and 7% for most investment grade type tenants. And you're looking at interest rates in the 7+%. So are you seeing clients still putting on debt, or are they maybe like in a 1031 exchange having to deal with a boot issue, things like that? Or is it much lower leverage that you're seeing nowadays?
Yeah, I mean, this is today's conundrum, right? Is the fact that rates went up significantly. The federal funds rate went up, 5.25, 5.5%. That's 525, 550 basis points in the federal funds rate. Obviously, it doesn't correlate basis point for basis point with rates. But if you look at cap rates, interest rates went from roughly, let's call it 3% to 7%. That's 400 basis points. But you'd be hard pressed to find a cap rate on any deal that went up 400 basis points. So the spread really isn't there. And if there's any metric that I want to look at to gauge the what would I call it, the velocity and the strength and the explosiveness of a commercial real estate market, it really is the delta between cap rates and interest rates.
Mhm.
Now, if you look at single tenant net lease deals, as you said, typical cap rates 5 to 7%. I mean, you can even get into the 4% if you're looking at Chick-fil-A's and McDonald's and things like that,
Yep.
Wawa's, Sheets, things like that. But let's just call it 5 or 6%, right? 7%, you're already pushing out into maybe some outliers. So all of those deals are going to have negative leverage if you get financing, right? So what happened was a significant segment of the net lease market became a cash segment, or a very low leverage segment, as you said, or a segment where people are saying, you know what, I can lock in at 6.75, with maybe some, idea that in 2 to 3 years I'm going to refinance. That is what a lot of people are doing. What I did 2 years ago when I saw this changing, when I saw $10 trillion of capital printed and put into the economy, and I knew that our system has two ways to influence the economy. It's very simple, right? Print more money, change interest rates. That's all we can do, really. And that's exactly what we did. $10 trillion of money printed, and then boom, let's pull those interest rates and raise them faster than we have in 40 years, okay? So when I saw that happening, I pivoted my business. I already had done significant volume in the shorter term net lease space, in the vacant property space, and in the shopping center space. And I knew that these 4, 5, 6 cap deals were going to be harder to transact on. So I started moving more of my efforts into the shopping center space, into the vacant property space, into the short-term lease space, because all those spaces were not going to be confined by higher interest rates, right? If it's short-term, higher cap rate, maybe no debt at all. If it's vacant, probably no debt at all, maybe debt, but not relevant, not as relevant. And in shopping centers are always trading above debt. Now they're still trading above debt. So you have that delta, right? So I think that that's something to focus on, is to find the deal that has the delta if you can't pay cash, because they do exist. It just might be a shopping center deal and not, a 20-year Starbucks or Taco Bell.
Yep. Well, you know what? I think that's a great transition, because I'm definitely seeing a lot of shopping centers come up, or, even out parcels to a shopping grocery anchored center, where you'll have that strip of retail that may not be a single tenant, but has 4 or 5 tenants. And I'm also seeing traditional single tenant net lease type tenants going into dual tenancy locations. Specifically, you're seeing some Chipotle's trying to convert out to a Chipotlane, or Starbucks taking an end cap that they can put a drive-through through. Excuse me. Things along those lines. So when I look at that, what do you look for in a retail center that is a potential value add opportunity for an investor? How would you take a look at it? I mean, there's a lot of turnover. You have weighted averages for the rental rates that you can take a look at, but more importantly, what strategies can someone use?
Yeah, great question. It really depends on the investor. I've got certain investors that I can tell you half a dozen of them in my head, their parameters. A lot of them are very similar. They're looking for, demographics that are, population density of, let's say, 150 to 200,000 within 5 miles. As you talked about before, they're looking for location. That's very important, right? We want to make sure there's not only a lot of residences in the area to, contribute to the customer base, but we want high traffic counts, right? We want 25, 30, 40, 50,000 or more in terms of the traffic counts. Those are the people that are going to be driving by your center and seeing your pylon sign and pulling in, right? This is very important. People discount this every day. We want good ingress and egress. It's so important. We want people to be able to get into a center. I can't tell you how many deals I've underwritten where the city had come in and put a median on the road and made it impossible to make a turn into a center or into a single tenant property. That type of a disturbance to the underlying fundamentals of the real estate is huge, and it can make something from a deal to no deal. I want to look, if I'm looking for value add, I'm going to look at the following. It's not that dissimilar, by the way, to multifamily. I'm going to maybe look at a little bit of deferred maintenance, right? Because deferred maintenance means that if I can deploy some capital expenditure, some dollars to make the property look better and feel better and have a nicer just overall appearance, I'm going to attract better tenants. I'm going to have a lower cap rate, and it's going to help my bottom line. Now, in addition, I want to go through my tenant roster. Any vacancies, let's say it's 92% occupied, or 83% occupied. I want to fill up those vacancies. Now, if I'm looking at a center, typically centers have, and this is an overgeneralization, but it's for the purpose of our discussion, they have either what's called a gross modified lease or a gross lease, or they have a triple net lease. And the only difference is a gross lease or a gross modified lease means the tenant pays their rent, but that's a gross amount. That's what the landlord gets, and the landlord has to take care of everything else: water, sewer, parking lot, roof, structure, management, everything, okay? On the other hand, a triple net lease is just like those single tenant deals we talked about. There's going to be what's called a CAM charge, a common area maintenance charge, which might be broken down as either a number, a certain dollar amount per square foot, or they have to pay their pro rata share of the expenses, meaning if their unit is 11% of the center, they have to pay 11% of all the expenses. So any lease that's a gross lease or gross modified lease, when it comes time for a lease renewal or a rollover, I should say, I want to convert those leases to triple net leases for 2 reasons. Number one, I'm going to be able to recapture the expenses, which takes away my uncertainty, because every year expenses are going to vary. If it's a gross lease, I might pull in more NOI one year than the next, right? Number two, it's more attractive to the next buyer, which does what? It lowers your cap rate. That's another great way to add value. Now, additionally, I see tons and tons of these, what I call like mom and pop owned shopping centers all across the country that have been well maintained, that are producing and performing, great little centers, but for whatever reason, the mom and pop never really kept their tenants up to market rent. That's a tremendous opportunity, right, for the new owner. You can then take that property, raise the rents at the rollovers to market rent. Now you've increased your net operating income further. So all of these factors are going to combine to lower your cap rate, right, through better leases, better tenants, and a better property, and increase your NOI through better management of expenses, as well as triple net leases and higher occupancy. And boom, you can, obviously it's hands-on, it's more hands-on, but you can now create tremendous amounts of opportunity and equity.
Okay, no, absolutely. Always looking for that value add opportunity that's there, whether it's in below market rents or the lease structures or how you can reposition assets. Now, I have some clients also that are acquiring large shopping centers that have out parcels. And what they're doing, they're acquiring a property like it's a grocery anchored center with a little retail strip, plus it has 2 or 3 out parcels. They're acquiring these at about a 7 to 7.5 cap right now. But they're spinning off, like if the out parcel has a QSR and it may be a Carl's Jr. or maybe one of the Yum brands, a Habit, or Taco Bell, and they're spinning those off at a 5.25 cap, and therefore bringing down their equity basis and increasing the overall cap rate that they actually had. So going in, understanding that, I'm going to go in to control the center, but instead of getting it at a 7.25 cap, I'm going to be able to control the center at a 9+ cap by spinning off the out parcels. Are you seeing that happen a lot, or is it more of a local regionalized, depending on the area?
Yeah, and just for clarification, you're talking about an entrance cap rate of 7 or 7.25, 7.5
Yes.
for everything, right? The center
Yes.
and the out
Yep.
parcels.
Bingo.
Yeah, that's very common. I mean, I see it not only from a come in, purchase, spin off perspective, but also I'm dealing with a $48 million development in New Jersey that is a large shopping center with exactly like you said, a Habit Burger,
Yeah.
a Starbucks, and then like a 3-tenant center and a 2-tenant center. And right now the discussion is, do we sell everything, right? Or do we spin off the out parcels? And obviously my advice is spin off the out parcels, because the guy that's coming in is going to do exactly what you just said. Why don't you take leave a little meat on the bone, but why don't you be the one that comes in and with your own development
in my
off? So very common, definitely.
absolutely. In my experience, what I found is that the whole is the parts are greater than the whole in some, usually. And so a lot of times if you can have that opportunity to spin it off, then you can actually increase your returns that way without mitigating your risk in that aspect. So what else are you seeing in the retail center side that investors should be aware of or look at? What would you do if you're acquiring a property? What would you be targeting right now?
I mean, if I'm looking in the retail shopping center space, I would do exactly what I just described. I would I'd find that property that's the location is great. The demographics are great. The traffic count's great. The ingress and egress is great. It's just that there's a little bit of vacancy. There's some gross leases. There's some deferred maintenance. There's some tenants that need to go. And then I would come in and I would, essentially, I would do all those things, add that value, and either hold it and refinance or flip it. If you want to flip that paradigm over to the single tenant side, I would do exactly what I'm advising clients to do every day. I mean, I've got a deal right now. I just had a conversation 2 hours ago for a listing of mine where, this is a very short-term deal, 18 months left on the lease with a great tenant. And the sellers think that there's no way that the tenant's going to extend. And they allowed us to have some conversation with the tenant. And tenant says, yeah, we love the location. We're not going anywhere. It's setting records, for sales and production. We'll sign a new lease right now. So, I would do deals like that where I can, come in and buy, it's an industrial deal. So I buy at an 8.25 cap, put on a fresh 10-year lease and sell it at a 6.75 or a 7 cap. So there's opportunity everywhere. You just have to have your eyes open. And sometimes it takes having a conversation with, with brokers like us to be able to open your eyes to possibilities to increase your wealth.
Absolutely. And I think that's a great segue to the age-old adage that I think we need to address. So I get often, a lot of clients always call because, people that don't understand single tenant net lease investments or how to go about the investments, the first thing that a broker typically sells against it or says against it is that, you're really buying part of the lease, and that as the lease ages and as the property ages, you're actually losing value, which technically may be true. However, there are, what would you do to mitigate that? I mean, it is, yes, technically true, but at the same time, there are strategies that you would do. Just like, if you're going to sell your car, you're not going to put it on the market all covered in mud. You're going to get it, clean it up, maybe put
Right.
on some new tires, things like that. So, what would you do with an asset like that? What do you tell your clients when it comes time to sell?
This is a great question, and it's a dilemma in net lease, right? Because like you said, typically as lease term burns off, right? Just like I just said, the 14-month deal is worth a higher cap rate than
Mm-hmm.
the 10-year deal. So there's a few things you can do to mitigate that risk. Number one, I want to touch on a big misconception. It's a surprising misconception. The number of people that believe that options are a benefit to the landlord. Okay. If you have, right, you're smiling, you're laughing because you know exactly what I'm talking about.
Yeah.
If you've got a 20-year lease with with 4 or 5 year options, you don't have a 40-year lease. You have a 20-year lease and the tenant is nervous because they don't want to do business there and then have to relocate. So they have the option to renew, not you.
Mm-hmm.
I would rather have a naked lease, which is a 20-year lease with no option. So that's actually something that is something to consider. Not that common, right? But I'd rather be able to renegotiate a new lease to a certain extent on my terms than to be fixed at the 5-year deal, because a 5-year deal is always going to have, you're always going to be in that 5-year cycle until the end. So
Mm-hmm.
that's important. Number one. Number two, I should have started with this, but the biggest way to mitigate is to make sure that it's a dynamite location. And
Yep.
that doesn't just mean the underlying fundamentals of the real estate. That's a huge part of it, right? Traffic counts, population density, ingress, egress, visibility, all those things, right? Household incomes, those are super important, just like they are with shopping centers. But what's also important is the entity level financials and the unit level financials. How
Mm-hmm.
is the entity doing? Do we have a guarantee from Rite Aid and they're not doing well? Do we have a guarantee from, Sumitomo Corporations of the Americas, which guarantees some, tire leases, right? A huge
Mm-hmm.
credit corporation with, worth $55 billion. That's on the entity level, right? How strong is that guarantee? What about this actual location, right? Is this a Taco Bell that's doing, $2.8 million in sales? Or is it a Taco Bell that's doing $1.3 million in sales? Because I guarantee you, if they're doing 2.8 million and their rent to sales ratio is very healthy, let's say it's 6%. Okay. When it comes time for that negotiation for a new lease, guess what? You've got leverage. Guess what? They're
Mm-hmm.
not coming for a rent reduction because they don't ever want to leave. And that's why, again, by the way, with the deal I mentioned before, that's a naked lease, no options. The
Mm-hmm.
tenant's in trouble, right? We're now coming in and we're going to negotiate a new lease, but they don't have the leverage to say, oh, well, it's a 5-year option. We're guaranteed it.
Yeah.
No, you're not guaranteed that. We could tell you to leave, right? So that's very important to have that leverage, right? Number one, to know the entity and unit level financials, and then to have solid, underlying fundamentals of the real estate.
Absolutely. I 100% agree with you. Location, location, location. Again, the fundamentals of the real estate. I think also you want to look at what is currently going on in the government. What type of municipal laws may be getting passed, or what's happening within the
Yeah.
industry itself. I mean, the fact that California just passed a minimum $20 an hour minimum wage for fast food workers, that's less rent that new tenants may be able to pay.
Yeah. No doubt.
So you have to look at the whole big picture of things, not just the immediate, I think, location, but also what's happening within the different municipalities and whatnot. Also, I think a great tip is don't just discount. Look at other traffic generators in the area, because
Yes.
the location may not look great, but it may have some amazing traffic generators. I looked at I think it was an Arby's a few weeks ago that was in the middle of, I want to say Wyoming or Montana. And, you're looking at this and the demos make no sense at all. And you're like, well, how in the heck do they have a under 5% rent to sales ratio? And then you find out that it's anchored at a super Walmart. That's the only super Walmart in 30-mile radius that has over 6 million visitors a year.
There you go.
6 million a year.
There you go. I forgot to touch on that. When
Yeah.
we look at a deal, you want to look at the surrounding national retailers, because if Walgreens and McDonald's and Chick-fil-A and Walmart and Target all thought it was good real estate, there's a chance it's good real estate. And to your point, those are going to be generators of traffic to get to
Mhm.
your location. There was one other thing. Going back to what you mentioned, there was one other thing I forgot to say that I think is super important. Okay. And that is, especially today, make sure when you're looking at a deal, if you want to secure yourself, as we were saying, in regards to a single tenant net lease deal, make sure that you've got a deal that's not paying above market rent. Okay. The big pain right now for pharmacy owners, Walgreens, CVS, Rite Aid owners that were, they were getting 300, 350, 400, 450,000, 500 grand in rent, right? Their backfill, the tenant that they can put to fill up that space, is a dollar store that'll pay 120, 140, 150,000. Maybe if they're lucky, they'll get an early education, childcare company like the Learning Experience that'll pay 325,000.
Yeah.
But in many cases, they're losing. And the reason is because those leases were signed with significantly above market rent. In a market where the rent is $12 a foot, these tenants are paying 25. Don't get
Mhm.
yourself in those situations.
Yeah. Yep. And the only caveat, if I can throw in there, Dan, is that understand the submarket as well, because in certain submarkets, there may be a moratorium on fast food drive-throughs or QSRs, things like that. In which case the demand is tremendous for them for second gen spaces. So because of that, the rental rates it's a competitive market, can be very, very high,
Yep.
comparatively speaking, on a price per square foot. For instance, I know of a Starbucks paying $325,000 a year that used to be a KFC that is only 1,280 square feet.
Wow.
And it's off corner,
Wow.
but it's in LA.
There you go.
And which had a moratorium on fast food drive-throughs, no Starbucks in the immediate area. But they came in, they actually paid more than Chick-fil-A.
Wow.
That was making a run for it as well. So it's the rents in certain submarkets are definitely there, and I look for barriers of entry. Whether understand that what your tenant's business is my recommendation as well, and understand how they may interact. Like for instance, you hear a lot about dialysis companies being a potential good tenant to have because it's a growth industry. They're relatively strong. DaVita, Fresenius, you have decent corporate structures, but at the same time, a lot of states are con states, certificate of needs. So there is a little bit of a barrier of entry, which then helps mitigate risk of potentially them leaving and having to re-tenant.
Yeah, you're right.
So always look at all that. Dan, it's been a pleasure speaking with you. We'll make sure your contact information is also in here as well. I'd love to do a follow-up video specifically just talking about retail centers.
Sure.
And different strategies and tactics to use on repositioning tenants and how to go about that to create value. I think that'd be
absolutely.
a great video for our listeners. I know that they'd love to watch it. And by the way, so that you do see it, if you haven't subscribed yet, make sure that you do. So just click on the button right at the bottom here and subscribe, and appreciate all of you for tuning in. And again, thank you, Dan, for being here and sharing all that wonderful information with us.
My pleasure. Thank you so much.
Great. Thanks.